Before we get started, I just wanted to let you, the listeners, know that I've introduced a paid subscription service where I will update you on any investment that I make on the day that I make it, all for 99p a month. I may only make 1 or 2 investments per month, but it may be interesting to you to know what I am investing in. Welcome to today's episode of Risk Required, the series and book all about the inside track to finance, the tips and tricks that could allow you to find financial freedom and retire from the 9 to 5. I'm Ed Pitford, and today we are joined by Pippa Gawley, co-founder and managing partner of Zero Carbon Capital. Pippa has been at the forefront of investing in deep decarbonisation technologies, working to support startups that are tackling one of humanity's biggest challenges, climate change. With a background in engineering and a wealth of experience from her time as an angel investor in California, Pippa brings unparalleled insight into the potential of early-stage innovation to drive sustainable solutions. Join us as we dive into her journey and the incredible work she's doing to reshape the future of our planet. Welcome, Pippa. I think we must have met back in 2020, albeit virtually, and you were kind enough to bring me in on some of the deals that you'd found. I was just wondering, could you start by explaining just a little bit about what you do, what you invest in, and what stage companies you're looking at?
Well, thanks for inviting me on the podcast, Ed. It's good to see you again and to be part of your journey from here as well. So yes, I think we met on Zoom, and at the time I was putting together our first fund with Zero Carbon Capital. And that was building upon work I'd been doing for the previous 5 years as an angel investor, as you mentioned, in California. We came back to the UK at the end of 2018 and looked around at the clean tech ecosystem in the UK in 2019 and started setting up the first fund. So what we're doing is investing in early stage companies, so pre-seed and early seed companies. That first fund was focused on the UK, but now we're investing across the whole of Europe. And we're looking for scientific innovations, so physical innovations that will accelerate the decarbonisation journey for the whole world. So for us, that means finding areas where there are emissions which are going to be a problem. So we don't yet have the technologies that we need that will get rid of the emissions in that area. So that might be that we have technologies that can't scale quickly enough, are too expensive, they're not going to be favoured by regulation, consumers don't like them, or other barriers to adoption. We look for areas where we think science can unlock new techno-economics, new ways of unlocking efficiencies and improving what the experience is for the end customer, and then investing in and supporting those companies that are developing those technologies. We're a fund, so in our case, we have about 50 limited partners, mostly high net worth individuals, a lot of whom angels I met along my journey. But with this second fund, we now have more institutional investors, corporates, fund of funds, that sort of thing. And we then turn that money into investments into our portfolio companies, which are, like I said, I mentioned across Europe. So we'll have about 20 companies in our portfolio at the end of the fund. And we expect them to be mostly based in the UK, with about up to around half in the rest of Europe.
Nice. And what kind of size investments are you making into these companies?
So with this fund, our typical initial check size is around £500,000, but we can go up to £1 million. So it depends upon the nature of the technology, the strength of our conviction, the stage of the company, what they need in terms of their funding requirements for the stage they're at. But we can also make a much smaller investment if that's all the company needs at that point. We've invested in incorporation rounds for companies where they just need a few $100K to get out of their university lab and get their first employees and kind of do a basic prototype. And we're happy to support that level of company as well.
Yeah, and you mentioned you're investing in stuff that is finding it hard to scale or not being supported by the ecosystem. Have you got an example of the kind of company that we're talking about?
Yes, so we've invested in a lot of companies now, which is great. I think a lot of them experience difficulties when they're starting out. These are all hard tech companies, and they're all scientific innovations. So there's a few kind of issues that often come alongside that. So firstly, a lot of the venture capital world, in particular in the UK, is focused on the business models of fintech and SaaS, and they're often slow to recognise the potential of more physical technologies, so hardware technologies, and to recognise the trade-off between the increased level of intellectual property development and the potentially higher returns that they can have. So they're not making that trade-off well. SaaS sounds like it's great and it's going to be low cost to scale, but it's not trivial to get additional customers, and often those companies struggle to defend their position in the market when new competitors come in. So we're looking for companies where their technology innovation will give them a sustainable competitive advantage, and that should lead to a kind of enduring source of value creation that will give them a different path to being a big valuable company than maybe another SaaS company. But in particular, in relation to climate change, we believe that this kind of physical technology is non-negotiable in terms of actually having the impact that we want to have. I think some of the fintech or SaaS or AI type solutions can be great in terms of generating and organizing data, highlighting where problems are, and driving money to the right area. But if we don't have the technology there, then we can't actually carry out the removal of the carbon that we need to. One example I can think of there is carbon markets. So there's a ton of companies out there who are looking at different ways of trading carbon credits, verifying carbon credits, selling them, etc. But again, without the companies who are actually sucking carbon out of the air, then those credits are worth nothing. So what we're focused on there is finding companies where we think they're doing it in a way that will have the lowest possible cost per ton of carbon removal, and supporting them on their journey to try and accelerate their growth.
Yeah. Just out of interest, where do you think the cost per ton will get to of actual carbon removal technologies as opposed to planting a tree or?
Yeah, exactly. So in terms of the kind of direct air capture market, so as you said, as distinct from I think the carbon removal world, you can look at things like point source capture and then direct air capture, and some of that there will be all kinds of different methodologies that people are looking at, everything from reforestation or afforestation to ocean-based carbon removals to engineered direct air capture, which is using again a variety of different technologies to literally remove carbon molecules from the air. That's where we focused our efforts, mostly because it's the clearest cut in terms of the quality of the carbon removal, and we think that the carbon markets are nascent and they're kind of struggling a little bit to really understand how to specify things like quality and permanence. But they will get there in the end, and we'll figure out how to price this commodity differently, just as we do with other commodities based upon its quality. Our bet is that the engineered DAC removals will end up being the highest value and the highest quality carbon credits. We're looking at just the fundamental energy requirements to capture that ton of carbon dioxide. So what that price ends up being will depend a lot on then what the cost of that energy is. So what the price of electricity is at that time. So given we can't foresee that perfectly, it's always going to be a bit of an estimate. But generally, we're looking at technologies that we think can come in under the kind of the oft quoted kind of line of $100 per ton, which seems to be the kind of consensus around what carbon markets might be willing to pay for the cost of carbon. It's well under what many studies have kind of calculated the social cost of carbon as being. So it seems like a reasonable level to shoot for. Of course, all things being equal, for the same, if we can reduce the energy cost, then that will reduce the cost of capture even further. So we are looking at companies that can make use of things like intermittent energy sources, so that they can co-locate with wind and solar, make use of curtailed energy or low-cost energy, and avoid some of the issues with transmission and grid connections. And that should enable them to unlock even lower prices. Yeah, that's quite exciting. If price can come down there, then actually climate change feels more solvable. Yeah, exactly. We've actually recently invested in a company that is going to generate carbon credits, capture carbon dioxide from sewage, which is I think just a brilliant example of a lot of companies talk about using waste to the extent that it's difficult to feel that waste is actually waste if it's such a valuable raw material. But I think there's not that many things we can do with sewage. So, if we can get that kind of value out of it and prevent that carbon from being re-released back out to the atmosphere, often as methane, then that seems like a really brilliant use of that, genuine waste.
Yeah, sounds good. Sounds exciting. So one quick question before moving on is, you said that you're running a fund. Is that a fund that listeners could invest in if they wanted to, or is that now moved into the institutional sphere?
Yeah, so I think this fund, our second fund, is, like I mentioned, we do have high net worth individuals in the fund. They tend to be, more sophisticated investors than kind of retail investors. So it's not really a fund that's ideally suited for the average retail investor due to the sort of high risk and illiquid nature of it.
So I guess talking both about your experience in California and your experience now with this fund, how do you go about finding the deals to invest in? Like how does a listener even start the search?
This is really an industry that is based on relationships. So, oftentimes, you get introduced to somebody, you get connected with somebody, you meet them at an event. So, I think there's no substitute for that, really. There's no shortcut. So we go to a lot of events, we attend conferences, we try and increase our profile in those events, like through panel conversations, this kind of podcast or newsletter, so that we're getting the profile that we need with the entrepreneurs that we think will be the best fit for us. And then we can work hard to maintain those relationships as well. So there's a lot there. And on the whole, that means, talking to like tech transfer offices for universities and for other organizations that might be interacting with these companies at the earliest stage of their life. So it might be a venture studio or venture builder. It might be an early stage accelerator or incubator. It might be some kind of organization that's giving them advice and support or helping them claim grants, for example. It's often also other early stage funds that we co-invest with, or later stage funds that we maintain relationships with, where they see something that's too early stage for us and they can kick it across to us to have a look at. So, all of those relationships, I'd say, generate the best quality leads that we get. But we're really, really keen to make sure we've got an open door to anybody that's got a great idea. So we have a page on our website. Anybody can upload a deck, and we promise to have a look at it. And we're all pretty easy to contact through LinkedIn or other websites like that, so that we can make sure we're not missing anything, and try and redress some of the issues with kind of network bias that we get, especially for underrepresented founders in this country and others.
Yeah, great. So then you find the company and they pitch to you, and what is it that you're looking for when someone's pitching to you? Do you have kind of golden rules in your head that they need to hit, or?
Yeah. So we have some red flags or like filters, which are would mean we're really unlikely to invest in a company. So the first is looking for that climate impact. So we're looking for a 0.5 gigaton of emissions reduction potential per year, which is roughly 1% of global emissions at the moment. So we need them to be looking at a problem space that is that big. And we need to believe that the way they're addressing it would make it believable that they could get the majority of that. So with their technology. So if there's already a ton of competitors in that space and they don't really have any clear differentiator, then it's hard to believe they're going to really have that level of impact. If their technology isn't going to be the cheapest, or if they're going to have limited feedstocks, for example, then that's a clear way to rule that company out. There's plenty of other funds who are focusing on lower levels of impact, and that's really important. And we need to have those too. We need to have all of the above in many cases, but for us, we want to make sure we're focusing on the biggest problems. If we do find an area that we think is interesting, but perhaps isn't quite there at that 0.5 gigaton hurdle, we try and do more work and more research to understand, like, is there something you do kind of further upstream that would include that space and actually include some other spaces as well. So a good example of that is like plastics and petrochemicals. So, if we look at a lot of individual chemicals, which might be really nasty and carbon intensive, but on their own, they're not responsible for 0.5 gigaton a year of emissions. But if we go upstream and try and find some of those building block chemicals, actually when we kind of set our head of research and analysis to look at that, she worked out that, there's like these 5 building block chemicals that are responsible for virtually all of petrochemical emissions. So if we can knock out one of those, then it will have the impact on all of these little kind of more specific chemicals further downstream. So that's one way that we try and address that. So that's our first filter is the emissions reduction potential. And kind of what we're looking for there is that viability. And what else are we looking for in founders? We want the companies to become a big, valuable company, because without that, there is no impact. There needs to be a viable business model. There needs to be a pathway to making the unit economics work out. Generally that means we're looking for something that will be competitive without assuming that we're going to have taxation or regulation that's going to support it. Something that could just compete on its own two legs against the incumbent solutions. We need to see that pathway there. And then, finally, we're obviously looking at the founders themselves. Do we think they are people that can make that company grow? So do they have the ability to explain their idea, explain its impact? Do they have the ability to attract and retain investment and attract and retain talent into their company? Because if they can't do those things, then the company won't be successful. Now, of course, we're often talking to companies when they're two people in a lab, and they might not yet have those skills developed. So we have to try and then look for their capacity to learn, their openness to feedback, their willingness to learn, and try and spot that potential within them.
And then, so are there any investments that you've made that they didn't go to plan, and then looking back on it, there's something that you could have seen in that pitch that you should have listened to or listened to your gut on, and you didn't?
Yeah, absolutely. Several. I guess some easy examples from the kind of my angel investing days, which I think might be useful for your listeners. So I started off investing in the US, but I also was really passionate about investing in Africa. I really wanted to, I had this idea of, investing in nascent technologies in the US and then investing in technology adoption in developing countries. And I thought, how brilliant, both sides of the same coin. And of course, I visited Kenya, found some companies, and learned really quickly through those companies not doing so well, that, investing in markets where you really just don't know them well is a really bad idea. So, I think if you do want to invest in places where you don't live or don't know those markets well, you need to have, a network of people that you can rely upon to give you insights. And you need to have somebody that's on the ground, ideally, to kind of keep an eye on things. So, that's a very kind of easy and obvious lessons. And some of these things sound so obvious, but I think when you start out investing, you need to make your own mistakes as well. You can read all the books in the world and get all these great advice, but until you've really experienced things going wrong yourself, it's difficult to hold those lessons to your heart. I think from our fund days, we've definitely invested in teams where we had questions about the team, but we kind of gave them the benefit of the doubt. And I think that's particularly important in terms of the roles and responsibilities within the team. So, are the founders kind of telling the same story in terms of what they want to do and what they want to be in their company? And make sure you get that sorted out before investment, because you'll never have as much leverage as you do before you've actually written the check. So, once you've invested, it's very hard to actually make the same level of change. Yeah. And on the flip side, what's your biggest success story? So I invested early on in the US in a company called Lilac Solutions, which is extracting lithium from brine. And they went on to do very, very well. I met them at a pitch event. I was literally one of the first external angels in that company. And they've gone on to attract investment from Breakthrough, Lower Carbon, and kind of, so it was a great journey. They started off with kind of mission-aligned angels and then climate funds, and then kind of moved on to more generalist investors. And finally, they've just closed a Series C round. One of the very few kind of tech companies who are reaching that kind of level of valuation and scale. They now have a factory that's making their product, their resin beads, and they are operating at commercial scale in brine resources. So they've really managed that journey very effectively, and are now have that ability to attract the kind of level of funding that they need to from the kind of bigger money markets. And so it was really great for me to have a sort of front row seat to some of that journey and learn from it, from what that can look like for a company, and what some of the challenges are. And I think in the UK we had a company from our first fund called Ekion, They've just closed a Series B with a US investor, and equally are managing to scale very rapidly through a joint venture with one of their supply chain partners. And they're a battery chemistry company developing high power batteries for a range of different applications. They've done a very good job of executing. But when I first met the CEO, it was still very much a lab stage company, and it's trying to see that potential for growth and that appetite for growth in the founder, because it has to be there. And sometimes, you get it wrong, and sometimes you get it right. And I think, that was the example of company that I think is really doing an excellent job of executing.
On the financial side, what kind of return are you seeing on the ones that win, kind of as a multiple or as an annual percentage? What does that look like?
Yeah, it's a great question. So, I think similar to many other investors in this space, I haven't had an exit yet, either from my angel portfolio or my fund portfolio. I think a lot of these companies are not the sort of things you can exit in 1 to 3 years, and we know that we're in it for more like a 7 to 10 year journey with most of these companies. So in terms of actual realized returns, there's nothing to really talk about. So what we tend to use instead is proxies, as you mentioned, from increases in valuation. So when our companies carry out a subsequent round of funding at a higher valuation, and we believe that it's a credible valuation, then we can mark up our holding accordingly. So for my angel portfolio, that's around 9x in terms of the initial money in, and then what that's worth today. And virtually all of that has come from that one company, which again is something that I think angels will often talk about, and funds, is that you have your 1 or 2 like runaway hits in from a portfolio, and you're not quite sure when you invest which one it's going to be. So you really have to look for that potential and believe it's there in every single one of them. And then for our first fund, we're currently around 2.6x. So that's mostly deployed in 2021. So we're proud of that, because a lot of the 2021 valuations are now regarded as being overhyped. Because we're investing mostly at pre-seed, that wasn't really the case, because pre-seed valuations rarely get very inflated. There's only so much that you can value a company when it's few people in a lab with a prototype, ideally. So I think we were more insulated from some of that kind of hypervaluation of that particular period. So as a result, I think that's one of the that's like a top decile performing fund from that vintage. However, it would be nice to have some exits. That gives a lot more credence to all of this.
Yeah.
But we are proud that we have 100% graduation. So that means they've all raised fund rounds at higher valuations, and also 100% survival from both of our funds so far.
That's impressive.
Yeah.
That's good. A lot of people, when I talk about investing with them and I talk about my target returns, and I'd say that kind of for a new investment, I'm looking for 56%, because that gets me my 10x in 5 years. And they think that's crazy. And then I look at my average and it's kind of like 30%. It looks like you're achieving these similar levels. And it looks like that is, for people that go it alone, they can get there. It's not ludicrous. Is that something you agree with? So when they're looking at their bank accounts at 2% and their share portfolios at 7%, mm-hmm. there's so much more opportunity out there if they go for it.
Yeah, I completely agree that in general, if you're able to take a higher risk and make this kind of early stage investment, that there is potential for huge returns there. Obviously, you should only invest capital that you can afford to lose, because it is high risk, right? So
yeah, but you keep saying it's high risk, but you've not lost a company yet, and they've all gone on to raise more.
No, but we also haven't got a return, and I think that's going to be the issue for most people, right? Is that even if you want to be an investor, your situation might change, and then you need your money back in 5 years or something, and often it's not going to be possible to get that money back in 5 years' time. So you have to be willing to you have to lock up your money for an indefinite amount of time. So, so for our fund, we're sticking to kind of fairly standard benchmark returns in terms of what we're suggesting to investors that we are targeting. So we're looking for like a kind of 4x multiple on invested capital over the kind of average holding of about 7 to 8 years, which equates to about a 20% IRR. So that's kind of interesting enough to invest to individual investors to kind of attract them into a fund, because it's generally more than they would be getting from, from a stock market or other savings that are safer. But, we don't want to overpromise in terms of what we think we'll be able to deliver. Do we think we will over deliver? Of course we do. Because we're very optimistic about these technologies. And as you say, like so far, haven't lost a company from our fund, but we also are only like 2 years into like a pretty awful financial recession, along with, geopolitical global unrest, which is certainly suppressing companies' ability to get investment. We've got 3 companies that are doing Series A rounds this year. It looks like they're all going to achieve that, but it's been tough. It's been tough, and valuations are not what they might have been a couple of years ago. And there will certainly be companies that fold in that particular stage, because what investors are looking for as, at the Series A stage has really shifted from that 2-3 years ago, when I think you could get away with a big vision and, a lot of confidence. And, I think now the level of commercial traction that is, required at Series A, and that the level of evidence for that is really like non-negotiable now with virtually all later stage investors. There's just fewer rounds happening, fewer investors writing checks. There's an awful lot of dry powder out there. So, I very much
about to say, do you see that coming back? Because I feel like we've almost passed the worst of it now, and the deals are starting to come back. Yeah. No, I hope. You're absolutely right. There's, we have a new government here in the UK. Hopefully, we'll see things settle down in the US. Hopefully, the situation in the Middle East and Ukraine will settle down, and then we'll see a renewed appetite to come back to the table, because there is that dry powder out there. We need to do something with it. Without that later stage investment, then, all of our early stage investments, yours and my kind of early stage investments, won't survive. So, it is a tough time at the moment. So they've pitched to you, you've made the investment, and I can see from your LinkedIn that you quite often take a board seat. What is it that you're looking to get out of having that board seat? And kind of when you're sat in a board meeting, what are you trying to achieve?
Yeah. So part of it is to say what we're going to get out of it, which is really just increased understanding of what the business is doing. So on a day-to-day basis, how are they making decisions? What is the team dynamic like? Who's making decisions? And that's all feeding into our model of what help do they need and what can we help them with. A lot of the time, that's really just being an external perspective. Again, board might be just the 2 founders and us for that initial period, and then post seed there'll usually be another investor and perhaps a independent director, or they might be more like 5 people. But for those early boards in particular, it's our opportunity to help them get the company set up well for the future. So, when we invest, we usually do a lot of work with them around like the cap table and kind of sorting out any problems there, so that they will be more attractive to later stage investors. So that might be things like making sure the founders have got enough equity, trying to reduce the stake of universities or other kind of early investors that can unfortunately often dominate cap tables by the time they get out to talk to investors. So we try and set them up well from the start. And then it's a case of making sure they've got good governance in the company. So again, even if it's just 2 people, that they are setting out a clear roadmap. They've got like clear checkpoints. They've got the controls internally to measure how they're progressing, and that they're reporting back to the board, to this external kind of perspective on how they're doing. And then, we can weigh in on decisions that they're making as well, to try and help them make those decisions, good decisions. With our experience, we've got, and with every company we invest in, they're all different technologies, all different teams and geographies, but there were definitely the same mistakes and the same issues that crop up again and again and again. For example, often scientific teams, it's a bit of a cliche, but sometimes they don't have the same kind of pace that more commercially minded founders might have. So that's kind of one of the roles that we can have, is like trying to hold their feet to the fire a bit in terms of keeping momentum up. And I think one of the main benefits we can bring is just having that investor hat on always. So we're always thinking about that next round that they're going to need to raise. Like, what landmarks is that investor going to want to see? What proof? What people are they going to want to see in the business? And making sure that that company ultimately is ready for that next fundraise. So they've, internally and in terms of their, the documentation they've got ready, so that they can go out to market. We can help them with warm introductions, and then they've got a much better chance of success at that next fundraise.
Sounds great. So it's kind of like you're just guiding them through the process, because you've had to go through it many times before.
Yeah, exactly. And we try and see it like that as a guide, right? So it's not, we're not part, we're not part of the business. We're not there every day. We don't know what they're going through on the ground. We're not going to help them with their technology. They're the experts with that, really. So it's really about kind of, being that Sherpa as they climb the mountain to try and make sure they survive.
And the salaries come up a lot. Kind of how much for a early stage startup, kind of pre-Series A, how much should the founders be paying themselves as a salary?
Great question. There are a number of studies out there, like Seed Legals does a benchmarking thing every year. So, there is some data that suggests that that as a rule of thumb, like seed and pre-seed stage founders should be getting well less than market rates. Whatever they could have been earning out there in the real world, they should be getting a lot less than that as a founder, mainly because it's so high risk and they're getting so much of the equity in that company. So, it's a kind of aligning incentives. So they need to make the company very successful, and then they will get the reward. And so as each round goes by, then they've demonstrated that they're de-risking the company, and therefore their pay can go up and get to more kind of market rates. Now, what market rates is kind of highly debatable, right? So I think it's easier when you get up to the Series A, Series B companies, because it's easier to benchmark that across different industries and say, this is what a CEO should get for this stage of company. But before that, it's going to depend a lot on the skills of the founder, on the sector they're in, what their alternatives are. But the reason we want them to be paid kind of market rates or close to it by Series A or Series B is that, firstly, if something happens to one of the founders, you need to replace them, and secondly, similarly, you need to replace them if they decide it's not the right thing for them. Like they want to be more of a technical role, or they don't have the right skills to do the business development, whatever it is. So you need to make sure you've got the space in the budget and on the cap table to attract a replacement.
Yeah, good advice. Thank you. So you've had a very successful finance career, but in a kind of predominantly male industry. What challenges has that thrown up?
Yeah, for sure. There's been plenty of times where I felt like we've missed out on opportunities, or I wasn't in the right room. I was underestimated because of gender. It's very much still a thing, sadly. We try and see it more, I think, again, as a unfair advantage. So, we have a predominantly female team. We have absolutely brilliant scientists who, again, didn't feel like they'd be taken seriously in other funds. We have founders coming to us saying, look, I've got a term sheet from this other fund, but that's 3 white guys, and it doesn't reflect who I am. And so, we find that we definitely get a lot more approaches from underrepresented founders because they know we're going to listen to them. I think it's a shame that it's still an absolute fact that it's in the kind of low single-digit percentages of venture capital money go to all female founding teams. It's just insane that in 2024 that we can sit there and say, 88% of startup money is going to all male teams. Just bonkers. There's plenty of women out there with brilliant ideas who are brilliant at running companies, and they're getting underestimated.
Yeah, and so you think that's predominantly because it's male VCs having that bias towards people like them?
Yeah, absolutely. I think it's there's plenty of studies showing that people tend to invest in people that are like them, and that's how the network, the old boys network works. You're more likely to meet people who are like you and like the people that you're already friends with, and the people you went to university with, and the people you've done deals with before, and that it's very self-reinforcing, which is, like I said, why we try and have that real open door. I think we've tried to use the platform we have to talk about this, encourage other people to do things like sign up for the Investing in Women Code to support women entrepreneurs, and to have more investor education to understand what the relevant skills might look like in different people. There's a lot around the kind of archetypal entrepreneur, which are qualities that we think of as being necessary for success, like this, the confidence, articulateness, the ability to take risks, the ability to inspire other people. And I think, in our society, we tend to associate those as being male characteristics. And, of course, that's self-fulfilling prophecy, because then we look for male characteristics and say they're going to make good entrepreneurs. So I think, it's not that we want, female entrepreneurs or other minority entrepreneurs to kind of like act like men, that's not really achieving the change that we want in the world. But I do think investors need to have a more open mind about what leadership can look like, and hopefully that can start to we can start to have more of those role models and inspire women to take up that path, and inspire men to evaluate women in a more broad-minded way.
You talk about the qualities you look for as standard that are quite male. What are the qualities that you might be looking for in a female entrepreneur?
Yeah, I mean the same qualities. We still need them to attract and inspire a team, but again, I think we've got a broader mind about what that might look like. Perhaps we have founders in our portfolio who are not very extrovert, right? They're not going to be the person jumping onto the stage and talking loudly. They're not going to be telling you about their phenomenal return on investment you're going to get in year 3. They're not going to be drawing hockey sticks. They're going to be a bit more quiet, a bit more thoughtful, a bit more considerate, and showing those qualities and inspiring people with those qualities, rather than just inspiring people with their the kind of more overt and kind of louder style of leadership, in a way that I think it comes back to needing to be authentic. And I think this is something that is talked about a lot nowadays in the business world, and especially I think the younger generation recognize that I think too much in the past people have felt under pressure to act in a certain way to be professional, and I think that the world is kind of coming around to the point of view that one mold doesn't fit everybody, and you've got to find what is right and authentic for you. So I think if we can find founders who show that potential, they show that integrity, they show that their values, and they show that willingness and ability to grow, that curiosity, then we have confidence that they'll be able to continue to develop those skills.
Excellent. And so a very difficult question to finish on. How optimistic are you that as a planet we're going to decarbonize in time?
I mean, I hate to sound down on this. We're not going to. I mean, it's just no two ways about it. Last year we were already over 1.5. So that's gone. All right, and there's tipping points that we're hitting now, which we can't put back. And we still don't. However much climate modeling has improved over the last few decades, and it really is phenomenal now. Even the best climate scientists are kind of shocked by how quickly things are happening. The permafrost defrosting, the oceans warming up, with the glaciers melting, all of these things, and planetary boundaries are being violated all around us. So we're not going to decarbonize in time. I think my hope is that that everybody will start to see the pain that causes. Because at the moment it's not really proximate enough. I think, especially people who are in, perhaps in a more comfortable situation. For us here in the UK, I think we might think that it's getting windier and wetter, but we don't have drought, we don't have hurricanes on our doorstep. We might think we'll be okay. But I think when we see that the impact that this is having in certain parts of the world, when you see the drought, the drop in soil fertility, the food insecurity, and then you see people turning to populist agendas, that leading to extreme governments getting in, geopolitical unrest, war, and then climate refugees. And so when we see the impact that this is having all around the world, and that's only going to get worse and worse and worse. And I think when everybody, I think, starts to appreciate that we're not just talking about turning on the air conditioning a bit more, we're talking about fundamentally making the world, not just a place that's lethal for a lot of people, but also just uncomfortable, unpleasant, difficult, sad. This is a world that none of us would prefer to live in, right? So, my hope is that these kind of negatives, sad as they are, will spur people to keep going in this direction. Will keep corporates and governments on the courses that they need to be, or adopting the courses that they need to be on. and making the changes to try and recover and to decarbonize as quickly as we can. Like I said, I think we're going to overshoot the 1.5, the 2, maybe even the 3 degree warming. I think it will be bad. But hopefully we'll keep on track to keep decarbonizing and correct that course before it goes too far.
Yeah, I was hoping you might have a more optimistic.
I mean, I guess. Look,
I know. Given that, how do you keep going? Because if you kind of almost see it as futile, it's just to have a least bad option now, basically.
Yeah, exactly. We've just got to do the best we can. We can't give up, So I think, the things to be positive about are like the huge progress that has been made in the last 5 years. When you look at, 2019, we didn't have, bans on EVs, bans on gas boilers. We didn't have legally binding commitments to reduce emissions in that cover like 2/3 of all emissions, right? So, we didn't have the IRA in the US. We didn't have the carbon border adjustment mechanism in Europe. So, we've got some incredible forces now that are happening. I think, virtually all, most consumers, I think, especially in Europe, are really on board with the idea of change. But, we've also seen how that is threatened when times are tough. So, I think ultimately the forces that are making the changes happen won't go away, and we will keep on this journey. I don't think it'll happen quickly enough, but I think it will happen. So if I can try and be a bit more positive at the end there.
Pippa, thank you so much for coming on the podcast. That's been really interesting to learn about how you find things to invest in, what you're looking for when people are pitching to you, and your thoughts on the green economy as a whole. So it's been excellent. Thank you so much.
Thank you, Ed. Thanks for having me on the podcast.
Thank you to everyone for listening. The book is almost ready. We're just waiting on the barcode, and then we can press go to the printers, and then we can get the copies out to those who pre-ordered. And I'll look forward to seeing you next time on the podcast, Risk Required. The information and opinions in this podcast are provided for informational and educational purposes only and do not constitute financial advice. The presenter, production and publisher are not responsible or liable for any analysis made by the audience based on the information in this recording. No parties warrant or guarantee the accuracy or completeness of any information. Audiences should always do their own research or consult an independent financial advisor who will advise based on the individual's specific circumstances.